Hello and welcome to our second update of the year with 24/7 Investment Management, where we're going to go through sort of what's happened and what changes 24/7 are making within the portfolios. So I'm here with Will McBride, who's our Chief Technical Officer and Chief Investment Officer for 24/7. So Will,
Hi. Okay.
what sort of has happened over the last, I know I'm asking you a big question here, over the last 3 to 4 months. What's happened there?
Yeah, it's been very volatile all the way through the year. Obviously, as we know, sort of the Iran conflict in the springtime with the Strait of Hormuz and the tensions there, which look to have got some resolution. Look like obviously they got a peace agreement, which was detailed in June. But obviously the last couple of days, and the date of recording, we've obviously had a little bit of escalation there. So that's going to feed in. So it's trying to gauge what impact that's going to have, how long that escalation is going to go on for. Obviously that can impact the models, impact inflation and interest rates. So that's sort of one we're watching at the moment, quite mindful of that. So other things that have happened, obviously AI has been in the ascendancy, the semiconductor space. The earnings that are coming through have been very strong. Spending's been very strong from all the AI, the mega cap companies that we all know. And at the moment, that's obviously feeding through. Growth's positive, earnings are positive, spending's positive, but it's still, we're being obviously mindful of that situation because we don't want it, if you get a pullback or the earnings are missed, the spend is there, but the actual, it doesn't materialize into profits, that can be a cause for concern. So that's something we're mindful of. Obviously, inflation's one that's always on hot topic. And I think that feeds back to the war, the situation, the escalation, because if it carries on longer, we've obviously got an issue with the price of oil. Yeah, that's an issue which impacts so many different, facets of the economy, and that leads to higher prices, which stokes up inflation. So that's something we're obviously concerned
But
about.
I guess despite all of that, portfolios have still done very well in the last sort of 3 to 4 months.
Yeah.
It's almost like everything that's been happening in the Middle East has almost been ignored.
Yeah,
by
it
the
has.
markets.
It seems to have been, the focus seems to have been more on the AI side of things. It's focusing on that sort of technology, where that's going to go in the next few years. Obviously, we have the IPO with SpaceX. There's possible IPOs coming shortly with Anthropic and ChatGPT. So the market's been quite bullish, quite positive. The US market's rebounded quite healthily. And it just seems to be looking through that sort of conflict at the moment. Whether that is maintained, if the conflict does drag out and it's this sort of to in and fro in, if there's a problem with the Strait of Hormuz, if it gets shut again, that could be an issue. On the AI thing, it's been an interesting market because you've had AI winners. Semiconductors have actually been flying.
Yeah.
Other sectors have benefited. It's almost like the market's now at that reflection point going, who are the AI winners? Who are going to benefit? Who are going to have efficiencies in their businesses through utilizing? But who are going to be the losers? And there has been losers. There's parts of the market down 20%, sort of software companies that are impacted, or they perceive they're going to be impacted by AI. Yeah. Because people aren't going to buy the subscriptions, they might do it themselves. So it's been a sort of a fragmented market, but mostly going in the positive direction. Portfolios have been doing really, really well. Yeah. We're above the benchmarks as we speak at the moment. Well above the CPI plus targets. So it's been pretty positive so far.
So looking at, obviously that's the past.
Yeah.
What changes are we making for this next coming sort of quarter stroke 6 months towards the end of the year as we get into this second half of 2026?
Yeah, sure. There's not a huge amount of changes because I think John mentioned last time in April we did quite a major portfolio review there with an overhaul. We trimmed costs a lot. We focused there. So at the moment, there's not a huge amount of changes, but there's a couple of minor tweaks, I'd say. The main ones, we've got sort of the global smaller companies. We've managed to get a reduced share class version of a fund, which shaves off. There's 2 funds we've got in that sector at the moment. Okay. It shaves off 2/3 of the cost on one of the funds and 1/3 off the passive comparison. So it's mainly a cost benefit there, but also the legal and general fund that we're going to use is it has exclusions to illiquid stocks and hard to trade stocks. So we feel that's a benefit for not having that sort of tail end of small cap stocks that you don't really add much value. Emerging market bond, we've done alterations there. Again, that sort of cost basis, we've managed to get a better cost point. Track exactly the same benchmark, but it's just reduced cost. The main change I'd say at this one is the alternatives.
Okay.
So we've increased the allocation to alternatives across
So
each model.
what do you mean by alternatives, just so that we can...
Yeah, sure. So
understanding.
alternatives are like property, infrastructure, you've got miners, commodities, and sort of strategies that are slightly different, like hedge funds that do a different thing, sort of long short funds.
But no real private credit or anything in?
No, that's it. No private credit. We try and keep things simple, but well diversified. So this change, we've increased the diversification of the alternative basket. We sort of look at the baskets individually, equities, alts, and fixed interest. And this is just trying to make it more resilient. We benefited really, really well from the gold and silver trade in the portfolio. Took profits there in January, and we're just trying to bolster that alternative, asset mix from that side of things. The only other change is a minor tweak is index-linked gilts. We've paired it with a lower duration fund, so it's just if interest rates stay higher for longer, we're just trying to minimize that sort of effect from that side of things. Yeah. So it's really the main change is alternatives. We've eked up the allocation there in the middle sort of risk models and lowered fixed interest slightly.
Okay.
Yeah.
And obviously with those changes coming in, it's impossible to know what's going to happen. But what sort of change, what do you think? Obviously there's a bit of a cost decrease, which is nice.
Yeah.
But in terms of the other changes, what do you think that sort of looks like in the future? And then I'll probably come to have a conversation about AI a little bit, and then we'll sort of finish.
Yeah, sure. Yeah. Obviously the cost benefit changes. If you literally replicating the same benchmark but a lower cost, that should compound through over many, many years. So that's quite a simple one. Alternatives, it's mainly just being intentional about how much risk we've got there.
Yeah.
The risk score now of say the balanced is pretty much lowered. It's low. It's a mid risk. Whereas I think alternatives before, we had more gold miners, we had more sort of real estate equities and infrastructure. So it was a little bit more sort of punchy on the risk side.
Yeah.
So we're just trying to, I think it's just to create a smoother path there. Obviously it's hard to sort of say what gold's going to do. It's obviously come off record highs. But if the escalation continues with the war side of things, the conflict, it could, if rates stay high for longer, gold could be impacted. So that's something we're mindful of. So we're just trying to spread the risk across different asset classes within the whole space to sort of mitigate.
So when you talked about the AI side, obviously, so we get a lot of questions from clients about AI, but also about a lot of people have an overexposure, I would argue, to the United States. It is the biggest market in the world. So we've always got to have some in there. But can you sort of explain our position on the US to maybe sort of reassure some of the clients?
Exactly. If you look at a global all country world index, you're roughly sort of 66, 67%. So it's 2/3 US. We prefer to have a more balanced view. We prefer to have a decent chunk in the UK because AI has been the ascendancy. That's been amazing. But if it does come off, the UK's got very little AI exposure. So it's sort of blending the two. You don't want an overexposure to a theme that's going to run away, but then could really, you don't know, it could come off if the earnings are missed. So we're trying to have a more balanced regional approach. We've got more in Asia than the global index. We've got more in the UK, as I said, and they do different things, they're different compositions. So in our tech space, we are underweight to the benchmark in the tech space, which some people like, some people don't. But I think we're trying to create that, I was going to say sleep easy at night, but more of a balanced portfolio.
Sleep at night's a term that we definitely would use.
Exactly, where you're not going, oh my, how much have I got in the Mag 7? How much have I got in SpaceX? Have I got, people might think they've got 5-10% where they have.
I guess the answer is nothing in SpaceX at the moment.
Exactly,
because it's not that in the funds.
And even if it was, it'd be minute allocation. So it's like,
Okay, great. So the main sort of thing there around AI is we're not massively overexposed if there was a correction there.
That's it, exactly.
If anything, we're negative on it and therefore in a better place.
Yeah, that's it. More of a balanced, broad portfolio across the range. Obviously, we do have more. You go at the top risk model, you're going to have a little bit more US, you're going to have a little bit more growth because that's the nature of the beast. But especially at low risk, it's
very minimal.
Minimal. Yeah.
Good. Great. Well, thank you very much, Will.
That's okay. Thanks very much.
That's our second quarter update from 24/7, and we'll have another one of these, I think it'll be in October. So if you do have any questions, please feel free to get in touch with us or your advisors, whether that be Carl or Tristan. Thank you.
Thank you.